In this specific video, we are going to share a timeless webinar by Professor Benninga on the topic of corporate valuation and Monte Carlo simulation using Excel. So, hope you will like this webinar by the legend Professor Simon Benninga. If you like it, please like the video and subscribe to the channel. Thank you so much.
I'm a professor of finance at Tel Aviv University. I've had a long time association with the Wharton School and businesses in various places, as you can see. I'm currently doing some teaching at the University of Amsterdam in Brussels, South America, and in Cyprus. Who knows, maybe someday in Pakistan. This is fun. I live in Israel. I was born in Holland. Well, you see the details there. I started off as a mathematician, and now I'm a finance guy. I do some consulting, although most of what I do these days is academics. And my special interest, which is also the topic of these two little talks I'm about to give, is in the implementation of financial models in Excel. That's also the topic of my books, most of my current research. There you see my research. Here you see the 4 books that I've written, all of which have elements of Excel implementation and finance sort of thrown in together. That's by way of introduction. What I'm going to do today is I'm going to give 2 short half-hour presentations. The first presentation, if I can find it. Both of these presentations, when you see the screen, you'll see that they originate from the Model Off World Financial Modeling Competition that was held last weekend in New York. Amazing and exciting initiative. I was honored to be one of the judges. And next week, you have Bill Jelen, who's also giving a webinar for Excel advice, who was also a judge in Model Law. So what I'm going to do is the first half hour, I'm going to talk a little bit about corporate valuation. The second half hour, I'm going to talk a little bit about Monte Carlo modeling and finance. 2 very, very different topics, both of which can be well done in Excel. So let me start with corporate valuation. Yes, my wife says there's a glare where my glasses are. So if I take off my glasses. Okay. So corporate valuation, here are the basic finance principles of corporate valuation. The enterprise value of a company, which is the value of the company's productive activities, excepting the finance. The enterprise value of the company is defined as the present value of free cash flow discounted at the weighted average cost of capital. The free cash flow is the cash flow due to the company's production activities. We'll define that in just a second. And the weighted average cost of capital is the risk-adjusted discount rate for, I'm going to turn off if I can figure this out. It's the weighted average cost of capital is the risk-adjusted discount rate for the free cash flow. Now, this is an enormous topic. This topic of valuation is probably the biggest thing that we as finance professionals or Excel professionals do. It's very complicated, and most of the models that we present in finance are very, very complex. And what I'm trying to do in this little talk, in this presentation, is to go in exactly the opposite direction. Instead of a complicated model, I'm going to try for a very simple model. The reason is that I do some consulting, and what I find is that when I consult in this area, my tendency and the tendency of other people who do the valuation is to produce models that are so complicated that it's hard to see the forest for the trees. So I tried to set myself some years ago the aim of producing a model which would be very simple, which would be, sometimes I call this model Yahoo-izable. So the question is, can I get enough data from Yahoo to do a basic financial valuation? And as you'll see, I think the answer is yes. Okay, so that's where we're going. So let's start with the free cash flow. The free cash flow is the cash flow due to the operations of the company. It's defined, there's several definitions. Here's one on your screen. It's defined as the profit after taxes, adding back the depreciation, because that's a non-cash cash flow, taking out the changes in net working capital. If you're watching this, I assume you know the reasons for this, but that, of course, has to do with the fact that the profit after taxes does not include the cost of inventories, of accounts receivable, nor does it include the cash benefits of accounts payable. And then you subtract the capital expenditures of the firm, and you add back the after-tax net interest. And the reason you add back the after-tax net interest is because the free cash flow should be a completely operational cash flow. So that's the definition of the numerator of this enterprise value equation. There you see it. Now, in practice, what we do is we don't discount all of the future anticipated free cash flows because it's just too much work and too improbable. So typically in evaluation, what we do is we discount a small number of free cash flows. In the equation down below, there are 5 predicted free cash flows, and then we take a terminal value. So what you see there is, I don't know if you can see my my cursor here. What you see there is like this. Inside the curly brackets, we have 5 free cash flows in years 1 through 5. And then we have this, the second term inside the curly bracket is the terminal value of the firm. And I've used here the standard terminal value equation that finance professors like to use. It's basically a version of the Gordon model where the last projected free cash flow, the 5th-year free cash flow, is expected to grow at some long-term growth rate. In just a second, you'll see that I also have a short-term growth rate for the initial free cash flow. And then, over here, I'm multiplying this whole term by 1 plus the weighted average cost of capital to the power of 1/2. And that's because I want to capture the effect that cash flows typically occur in mid-year and not at the end of the year. And that's the way to do it. Okay, I call that mid-year discounting. So here's the equation. And let me tell you briefly where this comes from. The model we're using here is a kind of balance sheet paradigm, but phrased in market valuation terms. So on the balance sheet, think of the balance sheet as having cash and marketable securities on the left side, and then the enterprise value, which is the present value of free cash flows, also on the left side, and on the right side having the firm's debt, its other obligations, pensions, it could be government debt, it could be, if you're talking about the American tax system, deferred taxes, which has to do with different depreciation systems, and equity. Okay, so there's a balance sheet of the typical firm. What I'm going to do is I'm going to estimate on the left-hand side the enterprise value. Then I will add the cash and marketable securities. So that will give me the total asset value of the firm. And then on the right-hand side, when let's say I want the equity value of the firm, I'm going to subtract the debt, and I'm going to subtract other obligations. By the way, in this talk, I'm not going to talk about how I compute the weighted average cost of capital, except sort of touch on it In my book, Financial Modeling, one of the longest chapters deals with this very sticky topic of how to compute the weighted average cost of capital. Don't have time for that today. Now, where do these numbers come from? Well, I've already indicated to you that I don't want to talk about the WACC. The free cash flow, there are typically two ways of computing the free cash flow. One, which is a method I've championed for many years, is to build a pro forma model for the company. A pro forma model for the company is a model that mimics an accounting model. It's quite complicated to build. You have to build equations or suppositions for most of the accounting items of the balance sheet, the profit and loss statement, and then you project from that model, project the future free cash flow. What I'm going to do in this model, in this presentation today, is I'm going to throw out my pro forma model, and I'm going to base my projections of free cash flows on the consolidated statement of cash flows. The consolidated statement of cash flows is the accountant's attempt to explain changes in the cash balances of the firm. And what I'm going to do is I'm going to say, I'll show you one of these statements that I get off of Yahoo. What I'm going to do is I'm going to take this statement and I'm going to turn it into a free cash flow. And that's going to be one of the starting points for my analysis. So let me start with a basic model that has no economic content, but that will explain the principles that I'm about to do. Okay? So here what you see is, you see in row 2, you see the current free cash flow of the firm, it's 1,000. You see the growth rate of the cash flows in the short term is 8%. You see the long-term growth rate, I'm going to use that for the terminal value. I've projected to be 11%, and you see the weighted average cost of capital of the company is, sorry, the long-term growth rate is 5%, and the weighted average cost of capital is 11%. Let me skip for a second to my spreadsheet. Let me show you this in a spreadsheet. I'm using, by the way, Excel 2013. Not that it makes much of a difference. And the other, by the way, is the organizers are going to make available a recording of this talk. Let me say that if anybody wants the spreadsheet, just try to. Okay, so here's my basic valuation template. All right. Here's the current cash flow, the growth rates, 2 growth rates, and the weighted average cost of capital. And now let's look at the future anticipated cash flows. So these future anticipated cash flows, they grow by the growth rate. So you see here's the first cash flow, D2 times 1 plus the short-term growth rate. And here, the previous cash flow grows by the short-term growth rate. You understand this, so I just drag this across. I'd love to talk about this also. I have embedded in all of my spreadsheets, I have a formula that I call get formula. Get formula is a macro that I've inserted into the spreadsheet that allows me to track the contents of the cells. And you'll see that I'm going to use this all over the place. Okay, so here are the future cash flows for the next 5 years, and here is the terminal value. Okay, remember the terminal value? Let's see, the terminal value is this term down here. It's the weighted average, it's the year 5 free cash flow times 1 plus the long-term growth rate divided by the cost of capital minus the long-term growth rate. See if I can get that. Yeah, there you see. Okay, that's the terminal value. Okay, so now to value the company, I have to sum these two rows. This is the cash flows in the next 5 years. This is the terminal value. This is the total value of the firm, the total cash flows, and now I discount them at the weighted average cost of capital. Those of you who have read my books know that Excel has an unfortunate error in the naming of the present value function. The present value function, meaning the present value of future anticipated cash flows, that should be something like PV, but instead in Excel it's called NPV. So this NPV function is actually the present value of the future free cash flows, and I'm counting the terminal value as just another expression of future free cash flow. And you'll notice that I've multiplied by 1 plus the long-term. I have a mistake. No, I don't have. 1 plus the weighted average cost of capital to the power 1/2. That relates to the fact that I'm assuming that the cash flows occur in mid-year. So here's the enterprise value of the firm. Here I'm adding back the initial cash balances. Here I'm subtracting out the debt. So here's the equity value. Again, let me just remind you where I am in my balance sheet. Okay, so I've computed the enterprise value. I've added back the cash and marketable securities. I've subtracted out the debt, and this simple model, this template, there are no other obligations. And when I do that, I get to the equity value. And now, just to take this all the way to the end, let's say that I have 1,000 shares in this firm, and my interest is in computing the value of a share. So the value of a share here would be 12,933 divided by 1,000, which is the number of shares. Okay, now before I go on, let me just show you a data table. I'm a huge fan of data tables. So I'm going to put in a data table, and I'm going to do a sensitivity analysis of the share value versus the long-term growth rate and the weighted average cost of capital. Okay, so I will put, I'm not going to make this a very big data table. I will put the long-term growth rate here below. I'm going to move this over one. You see why you should prepare ahead of time. Here I am. Anyway, I'll show you that in just a second. I'm going to put the long-term growth rate. Let's say it's 0%, 2%. We'll drag this out a little bit. 8%. That's going to be long-term. And I'm going to put the weighted average cost of capital in the left-hand column of the spreadsheet. And now we note that in this example it's 11%, but I just made up these numbers. Okay, so let me go and say 6%, 8%, and I'll drag this out. Okay, so now I have my two parameters for changing in this table, and the way the data table, so this is a two-sided data table, and the way this table works is in the top left-hand corner you put the parameter from the model that you want to exploit, that you want to vary. So I want to vary the per share value. Okay, so how do I do this? Well, I assume you know this. You hit First, you mark the data table. There you are. And then you go to Data, What If Analysis, Data Table, and now the data table command up here asks you what's in the top row and what's in the left-hand column. So in the top row, it's got to go find the long-term growth rate. And what's in the left column is the the weighted average cost of capital. And now you hit OK. Okay, and you say a little prayer to make sure that the creator of Excel is on your side. He's not totally on my side, as you'll see in just a second, but before I show you this, let's format this a little bit. And let's press Control-Shift-1 to get everything into 2 decimal place format. So what is this saying? Let's look at a row. Okay, so if the growth rate is 0% and the weighted average cost of capital is 6%, then the value of the shares is 16.29. And I can, of course, confirm this up here. Right? If the long-term growth rate is 0% and the weighted average cost of capital is 6%, took a while. I should probably discuss why it's taking so long. This spreadsheet that I'm showing you has a bunch of, you can have to believe me, this is correct. The spreadsheet has a bunch of data tables. Data tables are amazing tools, but they're notorious for slowing down the spreadsheet. So let me actually stop the data table calculations. Okay, I'm going to go to Options, Formulas, and I'm going to indicate, can you see this? Automatic except for data tables. I do this with a bit of trepidation because it means that when I put in numbers, they're not going to change until I push F9. But in any case, back to the point. In my model, if the long-term growth rate is 0 and the weighted average cost of capital is 6%, the value of the share is 16.29. And in this column, you can see that as the weighted average cost of capital increases, the value of the shares goes down. That's what you would expect. Okay? What do you see if you go across a row? Well, that's taking the same weighted average cost of capital, in this case 14%, and that's increasing the growth rate. And as you would expect, when you increase the growth rate, the value of the share increases. This is the long-term growth rate. Now, the problem is up here in this corner. You see there's some strange stuff up here. I've got a div 0 mistake. I've got 2 of those. And I've got a negative number. And that's because my formula for the terminal value, I should have added something to this formula. Okay, so the terminal value the terminal value is this formula, but only when the weighted average cost of capital is bigger than the long-term growth rate. It's actually a bit of high school mathematics. But so what I've got here is something that violates the but the long-term growth rate has to be less than the weighted average cost of capital. And these corners up here violate that condition. So what I'm going to do is the following. I'm going to go back into the left-hand corner of the data table. And I'm going to modify this corner with an if statement. So here's what I'm going to do. I'm going to say the following. I'm going to say if the weighted average cost of capital, that's cell B5, is bigger than the long-term growth rate, then I want to compute the per share value. And otherwise, I want to indicate that the figure that's not meaningful. So sometimes I just write, bullshit because I have a dirty mind, and that would type that word in my data table, but because I understand that we have probably a very decent audience, let me just put in 2 quotation marks. So that's an empty text box, and when I hit this, now the table didn't update because that's, you remember previously I said that I wasn't updating the table, so if I want the table to update, I'm going to hit F9. Okay, and there you go. So here is my basic example of a very quick way to value a company. Without building a huge pro forma model. Now, the question, and we've used a lot of Excel here. We've used a lot of techniques. Now, how do I implement this? Well, as an implementation, let me just look at a company that's listed on the U.S. Stock exchanges, which you've probably all heard of. It's Starbucks. And on the 29th of November, Starbucks shares were selling for $81.46. And I went to Yahoo. This is a very messy slide. I went to Yahoo and I took out the cash flows. This is the consolidated statement of cash flows for Yahoo, for Starbucks, annual statements. And what I'm going to do here is very briefly show you how I incorporate this data into my model. So the consolidated statement of cash flows is composed of 3 parts. There's the operating activities, the investing activities, and the financing activities. The free cash flow, by definition, doesn't include financing. So we're going to ignore this whole last part of the operating cash flows. And we're going to include the whole first part of the operating cash flows, of the consolidated cash flows, because that's the operating activities and all the adjustments. You see here, you add accounts receivables, you add the changes in short-term liabilities, the standard stuff that we do in a finance course. The only problem here is what to do with this middle section, the investing activities. And grosso modo, what I should do is I should take the capital expenditures and include them in my consolidated cash flows. And in my free cash flows, I should ignore these investments, which most likely refer to financial investments made by the company. And then I have this troublesome item called other cash flows from investing activities. Here's where my model breaks down just a little bit, because I really have to do some more research to find out whether I should include those numbers or not include those numbers. It could be that that's Starbucks activities in buying other companies, for example. You see it's negative numbers by and large, or disposing of some of their subsidiaries. It could also be that it's a purely financial activity. In any case, I have almost enough information here to establish the current free cash flow of the company, which is on September 29, 2013. Okay, here you see I've downloaded this data. Yahoo allows you to download the data into a spreadsheet, and I've turned the data into a free cash flow. Okay, so my starting point for my model is going to be 1153197, this number below. There you see it. And now I'm going to make up the short-term growth rate and the long-term growth rate. And I've done a little cost of capital calculation, which, as I told you, I can't really talk about in this short half-hour talk. I figure that Starbucks weighted average cost of capital is about 6.7%. So here's my model. Here are my future free cash flows. Here's my terminal value for the company. Here's my discounted value at the weighted average cost of capital of these cash flows. I've added back the initial cash of the company. I'm not going to show you right now Starbucks' current balance sheet, but believe me, that was the initial cash. I've subtracted out its debt, that's its financial debt, $1 billion, its other liabilities, its minority interest. I've gotten to the equity value of the company based on this model. I'm going to divide the equity value by the number of shares. I have to be very careful here. These numbers are in thousands, so this is really 38 billion. And these numbers are just the numbers. So to compute the share value, I've taken D17, multiplied it by So here I've put in an if statement that says no meaningful figure when the long-term growth rate is bigger than or equal to the weighted average cost of capital. And then I've used Excel's conditional formatting to identify valuations that are plus minus 20% of the current share price. So the basic idea here is I've used this very simple model to identify a valuation. So I identified the long-term growth rate and the weighted average cost of capital that are roughly consistent with the current share valuation. That's it. Half an hour, I'm finished. If there's a question from the audience, I'm looking at the questions. I don't think there are any questions. I see some of you are still here. 88, we just added an attendee. So that's my first little talk. Now let me switch to my second talk. This is also a talk I gave last week at Model Off. This is a current, I'm totally switching subjects here. Before I was talking about corporate finance, now I'm talking about Monte Carlo. I have to say that Monte Carlo, like valuation, is another one of these huge topics that we could spend. And when I teach my financial modeling courses, I spend half the course talking about this. So again, I'm only going to hit the very peak, the high points. So let me start by telling you a story. This is a story about one of my favorite characters. He's a professor called Amos Tversky. I don't know how many of you have heard of him. You've probably heard of Daniel Kahneman, who was an Israeli economist slash psychologist who won the Nobel Prize in 2002. He's making a lot of waves lately with the book he's written, and he's quite well known. Tversky was Kahneman's co-author, and sorry, unfortunately he died before the Nobel Prize was awarded. The Nobel Prize is not supposed to be awarded to someone who's not living, which is why Tversky didn't win. Some people say he might have, of these two guys, been the more imaginative economist. Anyway, Tversky, there's a story about Tversky. He was a teacher at Stanford, and he taught the introductory course in mathematical psychology. And on the first day of class, he would give the following homework assignment. He would say to students, look, make up a piece of paper, put your name on the top of the paper, only your name, and then if you were born on an odd numbered day of the month, like me, I was born on the 3rd of April. So if you're born on an odd numbered day of the month, go home, toss a coin 100 times, and write down the results. So you come back the next day with a piece, or the next class, with a piece of paper. It says Simon, and it has a list of 100 heads or tails. On the other hand, if you were born on an even numbered day of the month, then the assignment was put your name on a piece of paper and don't toss a coin. Imagine 100 coin tosses and write those down. So the next day, he was an immensely popular professor, so he had hundreds of students in his class, and the students would come in and they would put these pieces of paper on his desk, and Tversky would start to guess whether people had been born in an odd or an even day of the month. And he was very good at guessing. And the reason is, I have a slide about this, but I'm not going to show you the slide. I'm going to show you the spreadsheet. Actually, I'm going to show you the spreadsheet. I'm going to insert a spreadsheet. I'm going to show you how we do this. So suppose that we were simulating a coin toss. Okay. Excel has a function called rand. And there you see this function. There you see my get formula. Every time you push F9, rand recomputes. It's always going to be a number between 0 and 1. It's a uniformly distributed random number. So this rand turns out to be the basis for most Monte Carlo modeling. Here I'm Monte Carloing this coin toss, and what I'm going to do is I'm going to write an if function. I'm going to say if rand is bigger than 0.5 heads, and otherwise. Okay, so there you see it. And every time I hit F9, it's going to change. The spreadsheet, again, is a spreadsheet that's full of data tables, so hitting F9 takes a while. And now I'm going to do this 100 times. Okay. Just want you to understand that every one of these cells has this rand function. Okay, so this is a real coin toss, if you like. This is what the odd numbers, the odd birth dates, what they had to turn in. Okay, now if you look at this, what you will find is amazing runs. Okay, so for example, there I have a run of 6 tails, one after the other. I probably have an even longer run. Here, I'll show you this here. On this spreadsheet, what I've done is I've actually written a little function to count the runs. And here you see 100 coin tosses, and they have 10 either heads or tails in a row. Now, Tversky's contention was that it's almost impossible for a normal person to imagine in his or her head 10 heads or tails in a row. You just can't do it. So his basic contention in this course that he was teaching was to say to people, listen, you think you know about uncertainty, and in fact you don't understand uncertainty at all. Nobody understands uncertainty. Okay? Let me give you another version of this same contention of Tversky's. I'm going to tell you a little bit about my youth. This is Simon. Okay? I went to high school in Asheville, North Carolina, a very pleasant place. And we had a boys' bathroom and a girls' bathroom. I went to high school, a very large high school. And in those days, we boys used the toilet for the bathroom for three things. We used it for the usual set of bodily functions. That was okay. We smoked in the bathroom. We actually had a smoking area in my school, but it was so far away from the school that it was preferable to smoke in the bathroom. And then we played a game called coin tossing. I have to say that if you were caught either smoking or coin tossing, you were beaten. We had corporal punishment in my high school. We had an associate principal whose only job was to enforce discipline for the boys. So I'm going to show you how this coin tossing works. The way coin tossing works is like this. You and I both take an American penny and we both toss the penny. So what are the results? It could be two heads or two tails, or one head and one tail, or one tail and one head. While we're tossing the coins, one of us, let's say you get to call odds or evens. So let's say you call evens. If you call evens and we toss two heads or two tails, you get my penny. On the other hand, if you call evens and I get, you call evens and there's one head and one tail, then I get the penny. Okay, it's a fairly simple game, and we're going to play this game for 25 times, and we're going to see what are the cumulative winnings. So in the first round of this game, if Rand, right, the probability is exactly a half of either one of us winning. So if Rand is bigger than 0.5, let's say I lose one and you get one. Okay, there's my gift one. And in the second round of the game, I'm going to look at the cumulative. So whatever I've won previously, plus that same function, okay? Let me stop for a second and say that if I push F9, I'm going to recompute this. Okay, but obviously we could get different results. Looking for different results. I don't know. We'll keep going. So now I'm going to do this 25 times. If some of the people who are listening to this are wondering why we are wasting our time on describing the author's youth in Asheville, North Carolina, let me say that instead of calling this coin tossing, you could just as well call this a random walk without a trend. And those of you who have a little finance will probably recognize that random walks without a trend are the basics of security analysis in finance. Okay, so the stochastic analysis of securities prices. Okay, so here what we have is we have a series of the cumulative winnings for 25 of these coin tosses, and now I'm going to use Excel and I'm going to graph this. I'll just use a very simple line graph. So, what do we see? Well, let's see this particular game. So in this particular game, I lost twice, and then I won twice, and then I lost, and then I won, and then I had this amazing series of wins. Look at this, 1, 2, 3, 4, 5, 6. Now, somewhere along the way here, I thought that God was certainly on my side, because no matter what I said, I turned out to be right. Okay, but of course, it's all random. It's just noise. And you see that here, whoever was on my side previously is now against me. Okay? And if you hit F9, and if this is working, okay, here you see a different pattern. I'm going to hit F9 a couple times, and you'll see the patterns. Okay. We'll see how this is connected to security prices in just a second. But the point here is that the most rare result in this particular game is the one that you might expect. What you might expect is a kind of a zigzag around 0. It zigzags around 0, so you go up, you go down, and you know, the average of this game is obviously 0. But that's not what you see. What you see is a bunch of extreme results most of the time. In my presentation, so here I describe this coin toss. There you see some results. Okay, there you see a whole bunch of results. Here I've done it 120 times, but I wouldn't, or 114. I wouldn't dare do this on my spreadsheet that I'm showing you right now because it's got so many data tables. It's going to be way too slow. But the point, you see the point. You get a zigzag pattern, but it's rarely a zigzag around 0. By the way, there's some very high-powered mathematics about this called the arc-sine law, and it's the probability that in a repeated game like this, the probability of a half, who will be in the lead. Okay, it's the same kind of principle, and I've given you a wonderful reference down here by a Swedish academic described this in notes that are freely. Oh, okay. Now, how does this relate to modeling stock prices? Well, the basic stock price model is a model that says that returns are normally distributed. I'm going to show you this stock price model in just a second. I'm going to build it from scratch in a brand new spreadsheet. But I just want you to see what happens here. What happens here is I've got the annualized mean return. I've got the standard deviation of the return. I've got the initial stock price. And I have to say 11% and 15% are in annual terms. I need to model what the period is here. So here I'm modeling monthly stock prices. I can model, I'll show you in just a second, I can model daily stock prices by making this 1 over 250, which is approximately the number of days in a year. I can make it annual by making this delta T1. And the question is, what do these stock prices look like? Okay, let me just talk for a second about the theory. All right, so here's the first piece of theory. The first piece of theory says that the Excel function norm.s.inv, that's the inverse standard normal function, produces, when combined with rand, which is this uniform random number function, that produces random numbers that are normally distributed. I can't tell you why. Look in a good stats book and you'll find that, or in my book. The second part of the theory says that 1 plus the return on a stock is composed of 2 parts. There's the no uncertainty part, which is mu times delta t, where mu is the annual mean return of the stock. And there's the uncertainty part, which is sigma times the square root of delta t times z. Sigma is the standard deviation of the annual stock returns. Z is a random number drawn from a standard normal distribution, which I'm going to simulate, as I said in the first bullet, with norm as in. The upshot is that if the stock price at time t is S of t, then the simulated stock price at t plus delta t is going to be this. Okay? And that's what I'm going to simulate. Okay, let me show you this in a spreadsheet. I'm tired of this spreadsheet. I'm going to close it down. And I'm going to start a brand new spreadsheet. And I'm going to embed my get formula into this spreadsheet. Okay. It's a telephone. Get formula is something that you have to store somewhere. I'll send you a little piece of paper about get formula. I would like to call it my contribution to Excel modeling, but as you see, it was developed by an ex-student of mine, Maya Slinsky, a friend of mine, Benninga. So I can't take any credit for it. It's a small GBA formula. I hit Alt F11. I go Insert Module. There it is. And now, every time I type equals get formula, you'll see that I have get formula. I can tell you what's in the cell. So what I'm going to do here is I'm going to simulate the stock price. Okay? And let's see. I was going to have the initial stock price. Let's say it's 35. And I'm going to have the annual mean mu, let's say 12%, and I'm going to have the annual sigma, which is going to be, let's say, 20%. Okay, let me close the door and cut out some of the noise. And now I'm going to take the frequency. The question is, am I projecting daily, monthly, annually? Well, let me do daily, 1 over 250. And let me use Excel's naming to name these cells. So I'm going to call this mu. I'm going to call this sigma. I'm going to call this delta t. Okay, so now I'm going to simulate the stock price for 250 periods. That's a year. So I'm going to take time 0, 1. I'm going to go all the way down to 250. Actually, on average, there are about 252 or 3 business days a year, and I'm going to take the simulated stock price. Okay, so the first price is the initial price. Okay, now I've embedded my get formula here, so I could type get formula. Actually, I've got Excel's personal notebook enlisted to help me do get formula. And what I could actually just do Control T, but you can't do that. If you're going to get this, you have to type get formula, unless you put it in your personal notebook. Okay, so that's the initial price. What's the next price? The next price is, let me just go back and remind you. Okay, what I want to do is the next price is going to be this. Let's see if I can copy see, it's going to be S of t plus delta t. That's the previous price times this x. X is the continuously compounded return. So it's going to be the previous price times x mu times delta t plus sigma. Notice that the cells light up over here as I invoke their names, times the square root of delta t. Okay, and now I need this z. And what I told you before is in order to get a standard normal distributed number, I have to do norm S rand. Now I only have to put in enough parentheses to close these off. Excel color codes parentheses. So there I am. Okay, and now I can just copy this. So here I have stock price predictions for this model. Okay, at 35 is the initial price. The mean is 12%. The annual standard deviation is 20%. You can see what this is. I put this in a graph. Graphs are amazing. Okay, so there's my simulation. I'm going to delete the markers. If I wanted to make this more dramatic, I could also do this. I could, share price isn't going to go much more than plus minus 1 or 2 sigmas. So let's say instead of making the range from 60 to 0, which is the default here, let's say what I do is I make it from 30 to 60. And now every time I hit F9, this spreadsheet is going to recompute. Now, what's going to recompute here? Well, the only thing it's really going to recompute is the norm S inverse term. Okay? Because that's where the randomness is. The other things are all fixed. So here are a few F9s. Okay? Now here, it hit the bottom because I restricted it to 30. Okay? So I've just simulated a bunch of stock prices. Pretty cool, huh? By the way, if I change these parameters, suppose I were simulating a bond. Actually, I have to, I'm almost through here. Organizers, do I have more time here? How am I doing in terms of time?
You do have a couple of minutes.
I could take, I have permission to take a couple of extra minutes.
Yes, definitely.
So
definitely.
What?
Yes, definitely.
So I want to make an advertisement for Pakistan. When I was preparing this talk, you see, recomputing all these data tables all the time. It's insane. I used a wonderful app by a guy named Samir Khan. Those of you who are from Rawalpindi and environs will recognize the origins of that name. And there's his URL, and Samir has developed a little app to help you download stock return data from Yahoo. So I've used his app, and I've computed here for a number of these are actually mutual funds sold by Vanguard. I've used the app to compute for those mutual funds the annual returns over the last 5 years and the standard deviations of the returns. And I just want to show you the kinds of numbers that I make here. So here is Vanguard's S&P 500 fund, it has a mean return of 16% and a standard deviation of 16% over the last 5 years. Here are 5 bond funds. And you see, not surprisingly, that these bond funds, except for one that I'll talk about in just a second, they have fairly low returns and also fairly low standard deviations. The one interesting exception is the Vanguard long-term U.S. Treasury fund, which has quite a low annual return of 2.59%, but quite a high variance, high C. Okay, so I'm going to close this down. I needed to give Samir this credit. I've never met Samir, but I've totally fallen in love with him. So he's done a great service to the profession. So for example, suppose I was simulating a bond fund. Well, I might put in 2.59, which is Vanguard's long-term U.S. Treasury bond fund, and I might put in 12%. Drop the drama a little more. But I don't have time for this. You guys can do this for yourself. So, to return to the topic of, you see, this is quite risky, this bond fund. Okay? As opposed to, let's say, a Vanguard medium-term bond fund, which might have a return of 4%, but might have a standard deviation of only 7%. You see that the variations here are much less. Okay, so in the last half an hour, I tried to explain to you how to toss coins and how to get a BD if you go to Asheville High in the late 60s. And how to simulate a stock price. Let me just run through the rest of this presentation. So there's my simulation. Here's an annual simulation. Okay, so the statistics are up here, but now I'm doing, I set my delta t equal to 1. If you set the standard deviation equal to 0 in these simulations, there's no randomness at all, so you're simulating basically a bond. So here I am with a bond with 11% annual return, which is crazy. Anybody knows of a bond like this, please let me know. I'll buy it. Okay? But now we can play games. Like, for example, can stocks outperform bonds? So what I have here is I have 20 years of simulated data for a stock and for a bond. The stock looks a little bit like the S&P 500. The bond has 0 risk. Okay, and what you see is there is an area here where the stock underperforms the bond, but for long term, the bond will almost always outperform the stock. Or the stock will almost always outperform the bond. Here are a couple of these simulations. Is the stock. Okay. What about on a daily basis? So this is 1 year. This is 250 simulations. Okay. There's the bond, and you see that on a short-term basis, it's quite reasonable that the stock could underperform the bond. Unfortunately, I'm totally out of time, but if I had another hour here, we could talk about stochastic simulations of savings and consumption over time. So here's a problem where somebody starts and they have $100,000 or rupees, and they add $25,000 a year, and they want to make some kind of a target for retirement, and we want to simulate this policy. Again, without going into details, you'll understand that what I've done here is I've simulated the stochastic returns on the risky asset. Okay. Last thing in my book, I discuss something that I call data table on a blank cell, which allows me to run these simulations using Excel's data table technology over and over again. So here I've run the simulation 20 times to see who outperforms what the request is. Let me stop here and say that I thank you for your attention. And as I said at the beginning, if you write me, I will happily send you some of these materials, and the organizers are going to put the recordings on the web. So that's it for now. Bye-bye.
Thank you so much, Mr. Simon Benninga, and we thank all the attendees, and we look forward to more knowledgeable sessions from you. And definitely we are looking forward that you will come to Pakistan and live in person and give us the knowledge also.
As we say, inshallah, right?
Inshallah. Thank you so much. Very informative.
Right.
Thank you. Bye-bye.
Bye-bye.